Well, I think you can actually look and find some opportunities in the market. You talked a little bit about us adding to our banks. Bank position, JPMorgan is a position that we've been adding to because we think some of what we're seeing here, it's not a systemic issue across the entire financial sector, even though all the names are getting hit. So you want to look at some of these quality names that are out there. Look at their balance sheets. That was the key for Silicon Valley Bank, the issues on their balance sheet. So we look at JPMorgan, you look at their balance sheets and say, okay, they have stable deposit base. Their margins on deposits are increasing. You look at their cash position. They've increased their cash position to 15% of assets under management. So they are well positioned for liquidity events. And you want to combine that with some diversification of their business model, whether it's community banking, investment banking, wealth management, commercial banking. I mean, they have a broad sector of different types of clients and businesses, and they have a strong management team, which again is something I think we were missing, at least on the oversight for Silicon Valley Bank. So we're adding to some of these names that have been hit significantly.
So has this episode reset either your own growth or market or Fed expectations now?
Well, we were talking, 2 weeks ago and thinking maybe the Fed goes 50 basis points. I actually think a lot of what's happened over the last 5 days has done some of the work for the Fed, but I still think they're going to go 25 basis points, Scott. Look, we have got still a strong labor market. I know retail sales were a little bit weak, but core sales, you look at the last quarter for core retail sales, which is what feeds into GDP, that's running at a 10.5% annual rate. So I think the Fed is going to say, look, we still have work that we need to do, maybe not as much as we did before, but we're not completely done. So I'm thinking they're going to go 25 basis points and then take a step back and change that wording to say they're going to wait for those long and variable lags that we've been waiting for. Maybe the ECB tomorrow gives us a little look into what central banks are going to do globally, but I think they'll probably stay with their 50 basis point move that they have been talking about.
The problem is, you could make an argument that the Fed's been too fixated on the labor market, thinking that the strength that it sees in front of it is a sign that it should keep the pedal on the floor while minimizing the potential damage that they were doing to the system, to credit markets and the like. And now that they've broken something, that may influence how they should be thinking about things here forward, no?
It absolutely could change their focus, where they're not so focused on the labor market and they're looking at it more holistically. But I still think you're looking at a consumer. We're seeing layoffs in that tech sector. We haven't seen it broad-based yet, Scott. And I think that means the consumer is still there. They're still spending. We're still seeing it on credit cards. We're still seeing it within the consumer retail space that I talked about on those core retail sales that are there. You're seeing it in the airlines and the hotels and the travel that's going on. So I think they can look and say, there's a phrase that maybe they're too tight for the banking system, but they're too loose for the economy. And maybe that is where they're looking at how do they balance those two together. I think they can do it with one more 25 basis point hike and then pausing, knowing that everything that's happened is probably brought the recession closer to now than where we were a couple weeks ago, thinking it was going to be fourth quarter. Maybe we see it now this summer.
Lastly, before I let you go, what do you make? You mentioned tech. What do you make of the move in that space? The prospects for it now, whether they've changed over the last 5 days or so?
Yeah, well, you hear Zuckerberg talk about the year of efficiency. We've seen that across the tech sector. We see the layoffs. We see them trying to shore up some of their balance sheets in different ways when it comes to cost and expenses. They'll do better, I think, over the long run, but I still think short term, it's going to be a little dicey. There's long duration assets, and with volatility going on, I think you still have to be cautious there. I think they still have a lot of work to do. So I would focus more on something like HMOs. We like that space. We like some of the names like a General Mills, the Staples, or even a Lowe's. And like I said earlier, we're adding to our JPMorgan.